Welcome to today's digital discussion. What is asset optimization? Sponsored by EDF Renewables and part of our Road to New Orleans series, leading the way to SPI ESI and Smart Energy Week this September 20th to the 23rd in New Orleans. Here you can find upcoming digital discussions, the Great Debate Series, Smart Energy Market Tours, book and movie club discussions, and fun New Orleans-themed activities you can participate in right at home. As an attendee of today's webinar, you can use the code on the screen to receive your special discount for SPI ESI and Smart Energy Week in September. This offer is good for new full conference registrations through June 4th. And now, a warm welcome for today's panelist and moderator.
All right. We're on. My name is Eric Wessoff. I'm the managing editor at Canary Media, and we have a great, strong panel today to talk to you in this road to New Orleans lead up to Smart Energy Week, SPI, and ESI in New Orleans. In a post-pandemic New Orleans, I'm very much looking forward to absolutely doing that. One of my favorite cities. The topic today is what is asset optimization, and that could be considered a relatively dry topic, but it's not. It's what happens when a solar plant or a wind plant is paid for and has to operate for 30 years. And it's one of the more interesting, exciting parts of renewable energy, despite its insipid name. Forgive me. You'll have to. I'm sorry. I just insulted your title, Alexander. But the good news, if anybody's involved in renewable energy, you know that this is the best year that we've ever had for solar in 2020. The U.S. deployed 10 gigawatts of utility scale solar in 2020, and there's 37 gigawatts of utility scale solar in operation in the United States. And there's 112 gigawatts of utility scale solar under development today, or and even more on utility interconnection queues. So the great news is that prices are low, and politicians, consumers, and technology are aligned to really go to the next step and a different level of scale in renewable energy. But as we reach these levels of sophistication, things are going to have to change in the way we manage these assets, and that's what we're going to be talking about today. So if we can go around the horn, starting with Lee, give us a quick introduction to yourself and your company and where you fit into the renewable energy ecosystem.
Thank you, Eric. My name is Lee Connor. I work for PowerFlex, which is a subsidiary of EDF. I've been working in renewables for almost exactly 12 years now, and I've had the pleasure to be able to do a lot of different things, from construction management to asset management of large wind projects and large portfolios of small solar projects. And I'm currently focused for the last 2 years on building an asset management platform for behind-the-meter storage and solar projects and EV charging stations.
Okay, thanks. Mark?
Thanks, Eric. My name is Mark Harris. I'm a director of project finance in SMBC's Latin American team. Currently in the process of moving back to New York after 7 years in Latin America. Been based in Mexico City for 3 years, heading up SMBC's Mexican project finance team. Prior to that, it was in Santiago, Chile, responsible there for our Chilean business. And then stepping back, for those of you all listening who don't know, SMBC is a large Japanese financial institution. We're relatively pretty active in infrastructure or project financing. A large portion of that of our portfolio, and increasingly so, is lending to renewable projects. And then in terms of kind of benchmarking us and sort of where we fit in Latin America, we are in fact the largest lender to renewable energy, and globally we're generally 1, 2, or 3 largest lender in renewable energy. Thanks, Eric.
Thanks. Michael Ott?
Thanks, Eric. I'm with the Renewable Power Group, an infrastructure group at BlackRock. I've been here for 6 years. People probably know BlackRock from our iShares business and retail side, but we also have a pretty sizable alts business, and notably, one of our first infrastructure funds, the first infrastructure equity fund that we created, was actually on the renewable power side over 10 years ago. And we've now grown into a $9 billion business dedicated exclusively to investing in renewable power and ancillary infrastructure projects associated with that clean energy transition. With 50 professionals globally, investing across 15 different markets so far, and over 300 assets in our portfolio. Primarily focused on the OECD market, but increasingly also shifting into non-wind, non-solar, so that can include battery storage, EV charging, and things like that. So excited to be here today. Thanks, Eric.
Good. All right, thanks, Michael. Alexander, I didn't mention the EDF Renewables is the sponsor of this panel, and you're kind of the chief instigator of this. So I'd like you to give us a little introduction to yourself, but set the stage. Tell us. I think EDF has something like 10 gigawatts of projects under development and 10 gigawatts of projects that they provide services for. You've hit a certain level of scale, I think, and it looks to me like you're sharing with us some of your internal growth as a company as you confront this new world of renewable energy and scale, and you're somewhat coining a phrase, asset optimization. So set the stage. Tell us what asset optimization means to you. It's in your title. Tell us.
It is, yeah. So I'm supposed to say thank you, but you called me both insipid and exciting. So I'm going to say thank you because I think it was a compliment.
You're welcome.
My name's Alexander Boet. I'm a senior director with EDF Renewables in the asset optimization group. And have been in the renewable space for over a decade. I don't like to be precise. I let the gray in my beard do that for me. I've had varied experience, similar to Lee, have built power plants. I've actually lived in Chile, set up our Chilean asset operations business in Santiago. And I'm currently based on the East Coast in Charlottesville, Virginia. And as I said, I'm in the asset optimization group. So, right, what is asset optimization? Asset optimization, simplistically speaking, is all the stuff that happens to run a power plant after it's built for 30 years, right? Slightly more sophisticated description is, for EDF anyway, it is the coming together of all the various SMEs and functional groups required to run a power plant, and rallying that team of people around a very, very clear focus, which is to deliver the highest value per megawatt hour. Not necessarily the lowest cost or the highest revenue, but the highest value per megawatt hour. And the reason we think that's really important, and we've spent a lot of time, money, and energy in trying to figure out how to do something that sounds so simple, right? is because we really believe it's a competitive advantage for the assets that we own. And from a third-party perspective, we also sell services to the market, various scopes that from our world would live under that banner of asset optimization, right? So operations and maintenance, field services, remote operations, NERC and FERC services, regulatory, et cetera. So, as you said, maybe not the sexiest sounding business model in the world, but something that's very, very important to us and something that we think is going to become more and more important. And I think the reason for that, if we take a step back and we say, okay, so you said spend energy and time changing something, what did you change? And I think EDF is a very, very large asset owner. We're structured in a very conventional way, right? We had people who were asset managers. We had people who were operations guys, field operations, remote operations. We had engineers, right, who did stuff. We had regulatory and compliance people. And one of the things I think we've all seen is that the energy market, certainly in the US and globally, is getting far more sophisticated, right? You have to make decisions much more quickly. There's a lot more complexity in terms of the regulatory framework, in terms of the technology, all the things, Eric, you started this out with. All of that's true. And so in that environment, you can't have a structure and an approach that made sense 5-10 years ago, right? When the renewable energy world, right? I mean, Mark would love to invest in deals that were as simple as, giant utility, high PPA rate, busbar PPA, show me, the electron went through, here's money, right? Yep. That's not the majority of renewable energy right now. And Lee obviously has a lot more to say about that from the DG side than I do. But I think the point I'm trying to get at is, as the market has become more complex and the participants have become more sophisticated, you have to be able to operate your assets better and faster. You can only do that if you have a team-focused approach that's really, really targeted on making sure that LLC is performing at its highest possible level. Okay. And you can only do that if you have all the right people in the room focused on it.
So, Alex, first of all, I apologize. I didn't call you insipid. I called the asset optimization phrase. We'll work on a more exciting. You are exciting. You're very exciting.
Well, that's what I chose to hear anyway. So.
Okay. So to some extent, you're bearing your corporate soul of the change that you've had to make in your company to confront this new renewable reality. So to some extent we're watching the journey that your company is making to confront these changes, right? And
I mean, large owners are all going through this in different ways. I mean, I don't want us to think that EDF has the market on.
Okay. Could you put up the slide? I don't know if it's possible, Tim, to just put up the slide to talk about a little bit about what we want to cover today, the 4 points, or am I I'll skip that. I'll in fact, what I'd like the audience to get today is to understand asset optimization as we're talking about it. There it is. To understand the concept of asset optimization. Also, there are one of the things that we're talking about of integrating asset optimization under common roof is so that there aren't conflicting incentives amongst the different silos. And that's one of the things that this is trying to do, is to break down some of those silos. We want to talk about the impact of digitization. We want to look into the future of asset optimization. And of course, we want to generate thoughtful viewer participation and questions. And we'll hear from our viewers in the last 10 minutes of this. So let's hear from the lenders. Let's hear from the debt and the equity folks. Talk to us about, again, what Alexander was saying was that once upon a time, these things were rather simple. And now we have PPAs, virtual PPAs, synthetic PPAs, merchant projects, hedge projects of differing durations the world of solar projects doesn't come in one shape now. It comes in a lot of different flavors, and you guys have to be super sophisticated about this. You are super sophisticated about this, and you're putting more pressure. And to some extent, you can tell me if I'm wrong, you're pushing a little more risk onto the IPPs in your sophistication. Tell us about how the solar project world changed in your tenure, in what the projects you're looking at today compared to the ones you looked at a couple of years ago. Michael?
Sure. I would say, I mean, renewables have become mainstream in the last kind of 5 to 10 years. So these assets, as Alexander alluded to, are no longer bus bar, PPAs, bundled RECs, bundled power, limited to no curtailment risk, 25-year utility contracts. Where we've shifted to is these are generation assets. And there's a number of ways to stack revenues and optimize those assets. And, you know, my friends on the lending side may only give me credit for my contracted revenues, but the full value of the asset is much larger, and can be much larger, and can be unknown in terms of some of those revenue streams in the future. And so I think having a fully sort of people incentivized alignment between all the various stakeholders that are working for the project is a good way to try to think about, you know, being able to optimize the performance of those assets to take advantage of things like ancillary services and like.
Sure. And I imagine 5 years ago, the idea of having a storage attached to a solar plant was not part of the discussion. And that makes for a much more complicated performance way to judge. How do you judge the performance of that integrated hybrid plant? Right. Mark, what are the changes you've seen in the last couple of years?
No, I very much agree with Mike. The other thing we've seen, you know, sort of in addition to this sort of things tend to be more complex, maybe a little bit from our side, more difficult to finance, is that over the last 10, 12 years that we've been doing this in Latin America is, you know, we've run into problems, right? We've had situations where we have operating projects that aren't performing, and this old paradigm that Alexander was referring to of sort of various operating contracts, management contracts, maybe they overlap well, maybe there's some blind spots in there between contracts, that isn't, you know, that doesn't always work well. You know, when it works well, it's fine. When it doesn't, it can be pretty drastic. And so we've had experiences in Chile and Mexico that I've seen where this has happened, and contractors on sort of, you know, the service providers have kind of all halted work, pointed fingers at each other, which is not ideal for anyone, of course. But on the lender side, you know, I think it's pretty. It causes a chain of events which are pretty severe. You know, in our financing documentation that underpins our lending to these projects, you know, there are oftentimes defaults if there's a dispute at the project. If somebody's not performing their obligations, that means, you know, the minute it's in default, it's in default. We have to classify it as a non-performing asset. We have to take losses. And we're not letting a dollar out of that project, right? You know, there's no dollar going to equity. We may resize the debt. We may do some cash sweeps. So, you know, we're taking losses almost immediately. We're not letting any equity returns happen. And so what seems like a sort of improbable scenario, some disputes between contractors, asset management, operating, actually happens more frequently than you would expect, and has, you know, pretty drastic results. And I don't think necessarily that's being priced in or considered when sort of at the start of a project, developers or owners are planning, you know, how this is all going to happen.
Okay, thanks. Lee, your experiences, you're not on the finance side, but you've seen this world from solar, and now you're moving over to other types of assets. What are the changes you've seen over the last couple of years in terms of complexity, sophistication, and the pitfalls that Mark was talking about?
I mean, I think just to add on to what the others have said so far is that there are a lot of pitfalls and blind spots in some of these contracts. And I think originally, when you looked at the way that these project contracts were structured, you had an asset management contract and then a separate O&M contract. And those two teams were not aligned with the same goal, which should be, project optimization or making sure that the project is profitable. And so if you have an O&M team that is looking at it just from a how do I keep labor at the lowest cost possible, and then you have an asset management team that is looking at overall project costs, those two goals are not in alignment. And so I think by incentivizing your O&M,
they could drive labor costs down to zero. The performance wouldn't be that great, I would imagine, at that point.
Exactly. And I think all of us have lived through the pain of having some availability guarantees that really we're not driven by profit, right? So it's like you could have 99% availability, but you're only hitting 70% of your production target. And so it's really useless to an owner or to a co-investor. And so I think really by taking the time to create asset optimization as a concept and then realigning everyone so that they are focused on, profitability of the project, it's a win-win for everybody, investors and owners alike. And also, I'm sure it's got to be very nice for the folks that are operating the site to understand things from a financial perspective as well.
Of course. So Alexander, this Lee stole a bit of your thunder on this, but it's certainly in alignment with what you wanted to say. Tell us about these conflicting incentives that are under one roof within the EDF, under the EDF roof. There's a group that's interested in EBITDA, and there's another group that's interested in performance. And this is not theoretical. This is real. This is groups you've had under your roof, and I assume that the point of asset optimization is to align those incentives and not have them conflicting. But Lee gave us a great example. Could you go a little bit deeper into that? Because that sounds like the problem you're trying to solve.
Yeah, and I don't want to be too arrogant in saying we've solved it, but that reality that Lee's describing is something we recognized several years ago, and have tried to address, right? And so I think it's really worth maybe digging in a little bit to Lee's example of why that happened. And I think a lot of that comes from, frankly, from the ownership model that says, that doesn't properly allocate risk. So if you have somebody coming at a power plant that says, I don't want to take any risk, I just want to make money, and you try and push that risk inappropriately, right, to the various doers of work, service providers, you're going to get these unhealthy outcomes where people are going to say, well, all I care about, to use Lee's example, is keeping my labor costs down as an O&M guy, right? Because I don't want to get yelled at for being over budget. And so, but you can play that scenario out a lot of different ways. And I think what's really important is to focus on how, not just structure, but mindset, right? If you're going to own a power plant for a long period of time, you want to shift that mindset away from what we were talking about earlier, right? Where it's the job of the owner is to sort of review monthly reports and make sure nobody's stealing from the cash register, right? You can't do that. You have to think about your asset as something that needs care and feeding, and it needs specialists and a team to do that, to have it meet its as close to its theoretical potential as possible. And for me, that's sort of the big thing. And then when you translate that sort of tactically or commercially, right? So EDF services over 7 gigawatts of third-party assets. We don't just live this reality for our own assets, of course we do, but we also live it for our customers, right? And that's very important to us. And I think that's a differentiator in the way we approach the work that we do. Now, obviously, you have specific scope.
Alex, allow me to interrupt. That service you're providing for the third-party service you're providing, I assume, like every other piece of the cost stack in solar or any other renewable energy world, is going down, right? You can't ask for more. You can't raise OEM prices, right? Per kilowatt year, per kilowatt, whatever the metric is. That is that service is under the same price pressure that a solar module or an inverter is
So
under.
here's the difference, though. So this is actually a very good thing to talk about. So I think there's 2 points. First point is that they're not comparable because a widget is a thing, right? A service, particularly services like this, are provided by humans, and our costs don't go to zero, right? You can't make a big enough factory to, right? Well, maybe you could just to make lots of us. I don't know, but the point is that they're not really comparable, and so that logic, I think, has actually permeated the U.S. market, certainly, that says drive the OpEx down, drive the OpEx down, drive the OpEx down. But that's lowest cost per megawatt hour, not value, right? And that's different. And so if you think about what we've seen, certainly in solar, maybe a little less so in wind, is that folks have tried to strip out services from their power plants as much as possible to keep that OpEx as low as possible. Mm-hmm. Well, now you're sort of playing a game here, right? Because if you're actually going to own that asset for a very long time, do you really want to skimp on the services early? Right? Not necessarily. And I think that's often created maybe a bit of a misperception in the market where maybe we overshot on OpEx. Maybe folks got maybe a little too aggressive at times. Because if you aren't, at the end of the day, there's an underlying cost to run a power plant, right? And so if you as an owner are going to outsource that work and you're going to make assumptions about what that cost is, you have to make sure that cost is commensurate with a scope of work that you believe is going to get you the right outcome. And I think in solar, that's something we've seen a lot of folks try and get very, very bare bones scope for the first few years and then say, well, we'll renegotiate in 5 years. We'll see what happens. Right. So that's that. I guess what I'm getting at there is that it's not just a diminishing cost curve. There is a baseline cost, and B, whether you want to put it in your financial model and contract it as a fixed price, right? Or whether you want to say, I'll make an assumption about what it is, keep my fixed price low and just be willing to have a variable OpEx price. Both are strategically reasonable, but recognize you're going to have that cost. So the only question is, how are you going to manage it properly? And are you managing it with a group of people who are highly aligned to make sure your asset is performing at its best, whatever specific scope they're providing, whether that's you're hiring a third-party engineer, whether that's you're hiring an environmental consultant, whether that's you're hiring a field operations team, whatever the case may be. It's a logic, I think, that's really important. Or at least that's what we focus on.
Lee, are these same dynamics happening in EV charging, the EV charging infrastructure? Or so can you contrast? I mean, you're at the cusp of the inflection point of the curve, right? Maybe the world is not as sophisticated in the world of EV charging and monetizing EV charging. So is it a completely different situation, or are the dynamics similar?
Well, I think for the projects that we are deploying, we typically have either solar and EV charging, solar storage and EV charging. And so it isn't actually that simple. I think with incorporating battery storage, we get a lot of freedom and also a lot of complexity. So for some of the sites that we're managing, we're deploying a real-time energy arbitrage based on LMPs. And so that's equally as complicated as managing grid scale projects. And I think too, it's just changing the view overall of you have actual humans that can go touch all of these pieces every single day, and that they'll be, commonplace. I mean, they're already commonplace, I think, in California, but across the country soon enough. And so I think we're dealing with that same complexity and also trying to figure out how to create the best value for our customers, not just from installing EV chargers because their employees would like to have them, but how do we create the best value overall, including preventative maintenance and corrective maintenance, and making sure all of that is aligned, and trying to incorporate everything that's been learned on the grid scale side, on the DG side, as that grows.
Okay. All right. I'm going to switch gears to the financial guys a little, and I don't want to blindside you, but you're global companies, right? You invest all over the world, as does EDF. EDF Renewables is North American, but EDF is a global company. the United States has some of the most expensive utility scale solar costs, I'm pretty sure. And we have tariff issues and other things that make us unique, the United States unique. Is there a money's going to flow to easier places? Is the United States a tricky market? Mark and Michael, is it easier or harder to invest in? As I realize it's a brilliant, massive market, but if it's overly complicated, money will go to easier places. Is there that type of dynamic going on, or what? Can you tell me a little bit about investing in the U.S. projects versus international projects?
Sure. Yeah, and I've personally worked on investments in LATAM and APAC region as well, so I can talk a little bit about that. I would say on the cost side, yes, there are tariffs. There are some headwinds there in the U.S., but there are other markets where labor and other red tape is actually pretty limiting. So you take the utility scale market for solar, for example, in Japan, and it's challenging. There's a lot of challenges there, and costs are much higher. So I actually think there's a lot more tailwinds than headwinds for the U.S. market, just in terms of where things are going. And yeah, there is some complexity. I think, like everything in the U.S., we like to work through the tax code and work through tax incentives to motivate our industry, but certainly encouraged by the Senate bill that was moved forward yesterday for the industry, just in terms of not just incentivizing wind and solar, but storage, transmission infrastructure, which is super critical to kind of move the power from rural parts of the country to places where there's a lot of load center. So we're very bullish on the U.S. market. I think it's going to be a big year, big couple years.
Indeed. Mark, you have enormous Latin American experience. I just contrasted to working in the U.S.
Sure. No, I think that's right. I think, over the last 5 years, we've had public auctions in a lot of countries in Latin America, and we've seen in several cases that the prices awarded for renewable energy were at that time the most competitive prices globally. So does that make sort of it more, U.S. prices is sort of, I'm not as familiar as the rest on this panel, but it seems like there is added complexity in North America, though in Latin America it's challenging, right? I think, to return to a point that Alexander made, is sort of this driving to the bottom of O&M costs of power prices is it makes, certainly from a lender perspective, it presents some challenges, right? We've been doing this 10-12 years now, and we've been learning and each year making mistakes, and one of the things that we've become more sort of stringent about is exactly that: operating costs. We don't, at this, there was this huge drive to provide the lowest O&M costs in the industry, and what we found was that we couldn't take those contracts at face value, right? That there would be cost overruns, there would be additional costs in there. And so what we're doing now is, to the extent that there is this atomized structure of contracts for the operation of a solar project in Latin America, we're going to the model and we're saying, all right, your contract that says it's X dollars a year, it's not going to be that. It's going to be higher over the long run. And we're reducing leverage based on that. So to the extent someone like an EDF comes and says, hey, we have a more holistic, broad scope agreement that better aligns incentives, that has people that they've worked with before, that means that for me, I can rely on that more than I can sort of individual contractors that aren't working together. So I think that is, that's hugely beneficial. This, if we kind of refocus on this asset optimization idea, is that kind of shift is there are tangible benefits from the lending side, not just leverage that I just mentioned, but also pricing, right? When we put together our pricing for a deal, we're factoring all the counterparties that are involved in the deal. and we're factoring contractual risk, dispute risk. To the extent that is mitigated or minimized, then we can potentially offer some better pricing. So I think, there are, as we shift away, I hope from the old paradigm to something new, I think there are benefits from the financing side, which mitigate some of the challenges of doing business with these low aggressive prices in Latin America.
Okay. I want to maybe take on a different topic of digitization, and hopefully I'm coming from the right spot. But I recently spoke to a utility solar software startup who thinks that they can use their software to drive maybe not United States pricing, but global pricing down below a penny per kilowatt in solar. Kilowatt hour. Sorry, let me get the units right. And the reason they say this is because although we've installed millions or hundreds of millions of solar panels, the actual number of projects we've done, the actual unit, if the project is a unit, it's only hundreds or thousands. There's only 100 bigger than 100 megawatt solar projects out in the United States. Now, my point is that if we're talking about the iterative nature of a solar project, we haven't done that many, and there's a lot of room to grow by digitization, software, automation. I hope that makes sense. In other words, if the unit is just the project, we haven't done it that many times, whereas we've done 1 million residential solar roofs. We haven't been able to do the time motion studies that much in a solar project. So, Alexander, I'm asking you. So here's a solar software company that thinks they can drive down costs just with software, just by digitizing, just by creating models of this and working on it. So that's your segue to tell us how AI and digitization are going to improve the entire asset optimization, that 30 years of
value chain. Yeah. So I'm not a software engineer by training, but I am a skeptic. So I generally get a little nervous when people say it's cool, write some code, it'll solve all your problems. It usually doesn't work that way when you talk about heavily regulated pieces of equipment that are critical infrastructure that can kill people, right? If they go wrong, have lots of steel and glass and concrete. And so always a healthy dose of skepticism to say large infrastructure is going to get super, super cheap because somebody wrote some cool code. However, I absolutely agree with the premise that by building new and better digital tools, you're going to be able to scale and bring costs down. So what I mean by that is, Lee lives this more real time than I do, but when we think about digitalization, the first question you want to ask is, you can always have a new jazzy software tool, right? Cool. What are you accomplishing, right? How are you actually going to drive value? And so if you then go back up to my opening thesis, which is asset optimization is a really good thing because it brings lots of smart people who work very hard together in a team-oriented fashion, right? To make decisions quickly, to be forward-looking as opposed to backward-looking, which is what historically our business has been. Then getting them information, good information, right? Consistent information allows you to do more with less. So in a very practical sense, you can do that. Now, you can drill down on that example and you could find a very specific one, right? If you are able to very, very efficiently translate all the operational data coming off of wind plant X, everything that technician touches, every piece of equipment that is consumed in that turbine, the minute that work starts to the minute that work ends, correlating to the wind speed, right? You start doing that. Yes, big data analytics is going to help you a lot. Penny a kilowatt hour. Don't know about that, but very much agree with the philosophy.
Startup has to say something to get funding,
I get it. Right? Everybody's got to sell something for a living. I very much get it. But yeah, I think, but what I want to, at least from my perspective, having been through this a lot in different countries, right? I mean, I've rolled out a full ERP platform, both from an accounting side, but then also, from the operational perspective. the greatest value that digitization offers us is the ability to standardize our data and decrease our churn. And like we talked about in AO, our biggest cost isn't panels, right? It's people's time.
Mm-hmm.
So to the degree you can stop wasting those people's time, you're going to win. And then to the degree, the next level of that from a tools perspective is to let those people make decisions with better data. They're going to get better outcomes than the next guy. And that's how you get more competitive. And that's how you drive down prices. And ultimately, we look at AO not as, sort of a cradle to grave thing. CODs happen. Here's the power plant. Don't screw it up, right? Make sure Mark gets paid. That can't just be the paradigm. It's got to be, okay, what have we learned? How do we translate that back to development, to the front end, right? And you keep that iterative cycle of innovation going. And that is how we as an industry are going to keep getting better. And digitization plays a big part of that.
Okay. I don't need any help in encouraging my skepticism, so I was trying to throw a little bit of optimism into that mix. I do think I've watched software eat solar to some extent, and we're seeing that maybe more so in residential than we are in utility. But I still think just smart software can it's not a magic bullet, but it can help things for sure. Yeah, Lee, on your end, what is digitization doing in the EV charging, storage, distributed energy world?
So I think with battery storage, you have to have a software development team, because we have now an energy management system that we are running, and you have algorithms that are learning based on actual building load and other things, how to make sure that we're optimizing performance of the battery. And then the same thing with EV charging. PowerFlex is the only company that offers what we call smart charging, where we're able to really make sure that we don't drive up demand costs, because we have a load management controller, that we have our own algorithms that we've written to make sure that when you have, however many people, 50 drivers show up and charge at the same time, we can regulate, how quickly that electricity is pulled from either from the system to their car.
The grid or the battery, I'm sure.
Exactly. And so I think digitization is absolutely key for us to be able to provide the best product to our customers. And I think also on the analytics side, if you look even between 5 and 10 years ago, what a typical asset manager was doing is they were populating their monthly operating report, something that was in Excel, and making sure that the numbers were right. So when I presented to Mike Ott at BlackRock, he wasn't like, Lee,
he didn't
your numbers are wrong. Your numbers are wrong. And, so it was like double, triple checking, making sure you had analysts that were looking at these numbers. And clearly, that's a much better job for a computer. And so now that we have created platforms out of necessity with, to use for battery storage, we also have automated monthly operating reports, invoicing, a whole bunch of things that used to take a long time, where we were pulling tariff rates that change every 15 minutes, or trying to calculate what the curtailment loss was, all those sorts of things. We're now able to automate all of that. And so I think that does bring us to scale. And, the overall impact of how that drives down cost, I think remains to be seen, but it makes it so that, my team can manage 100 projects as opposed to 5. And so I am definitely very excited about how quickly we can process things. We still double check things. There's still sometimes data quality issues, but we had data quality issues before. So, I think that digitization has been a huge improvement for this industry.
Okay. I think we've addressed some of the topics we strove to, but we're getting some questions coming in that I think allow us to address the future of AO. And so let's go with that. Here's a question coming in from the organizers of the trade show. In fact, Alex, you mentioned that asset optimization is finding ways to deliver the highest value per megawatt hour. Is it something like finding ways to sell electricity on the wholesale market during peak and charging during the day when the sun is shining? Are you considering asset optimization part of the TOU gaming the TOU rate? Is that part of asset optimization is dealing with utility rates, according this question asks?
I'm not entirely sure. So here's how I would answer that. People in the asset optimization team who are responsible for a particular asset we own, wind, solar, whatever the energy market that particular asset participates in, they have a responsibility to maximize the value. So does that mean that they're going to have to try to optimize the trading strategy of that energy? Yes. What that is, well, you'd have to get very specific to the particular asset. You know what I mean? So I think the way I hear the core of the question, I think it's yes. But in the context in which I answered it, right? Okay. So understood. Energy trading strategy is absolutely part of, in our organization, AO, that would be front and center, right? Because that's how you're going to drive the highest value per megawatt hour. That's the piece of that puzzle.
Got it. So let me just we'll do the lightning round of questions, or we'll start with this. How, as asset owners or operators, are you working with your equipment manufacturers to improve long-term success? So they're not talking about driving down the price of a module, but they're talking about spare parts supply, service contracts, knowledge transfer. I mean, this falls absolutely under AO, right?
Most certainly does.
And so part of your challenge is to drive AO through your supply chain. Is that to some extent you have to vendor
to a very large extent. So EDF has really focused, particularly in the last few years, and this is more true on the wind side, right? Focused on supply chain, because one of the things as asset owners we firmly believe is that as the people who own the asset and the responsibility of the asset, we have to control the asset. And a great way to do that is to make sure you have the parts you need. And so a great way when you get to a certain scale as an owner to drive the highest value per megawatt hour is to decrease your widget cost, right? And so to the degree we can do that by buying bulk flow parts, to the degree we can do that by obviously being thoughtful about warranty obligations and but parts that may not be branded but meet the spec, those sorts of things, that's a way to drive value. And then from a third party perspective, that's something our customers appreciate because EDF has that infrastructure, right? And so part of what I do and my team does is say, okay, well, how can we provide that value to the market? Because we consume that value for ourselves and our owned assets, and our partners, cash equity, tax equity, and the like, they benefit from that. So people who do business with EDF from an O&M perspective, as an example, is there an opportunity for us to provide a centralized inventory solution to them that can add value? We certainly think so. And I think the other piece of supply chain specifically, it's very easy to jump on cost, right? Buy lots of widgets, get them cheaper, right?
Yep.
And that's important, and you have to do it. Have competitive bidding processes, drive down price, right? All good things. But the other piece is risk mitigation, right? So making sure you have that very inexpensive part that could have a huge impact in a down turbine, right? Or, a filter or whatever for an inverter or something is equally important. So that's another angle of supply chain that matters. It's not just getting stuff cheaper. It's also having stuff reliably available, because nothing will drive an asset owner crazier than saying, so you're telling me you could have fixed it, but you didn't have the thing you needed to fix it? That's not a conversation you want to have.
Okay. So, you've coined this term, asset optimization, but it's really just realigning your internal processes to keep your eye on the prize and the goal of a high performing 30-year asset, right? I mean, there's no magic trick. It's just a corporate realignment of eye on the prize type of thing. Yes, is that no?
No, I don't think so, because a corporate realignment, I mean, if you just say if you don't embrace the philosophy and you don't focus on the sum of the parts being, you know, greater than the whole, then you sort of miss the point.
Well, but
right?
but that's of any corporate value.
Yeah, okay. So fair enough. So if we agree that's the field in which you play, then yes.
So financial people, we are actually running out of. We're coming to the end of this. Alex has made these great promises. All of these IPPs have made these great promises about asset optimization, keeping this project going at full bore for the next 30 years in an economical way. How can you be anything less than 100% aligned with this direction and this goal? Or I guess my question is, are you 100% aligned with this goal and direction, or is there a downside or a potential pitfall in the future with this type of thinking? I know you're the sponsor, Alexander, but I'm hoping that, you know, we want to shine a light on this. It
doesn't hurt our feelings. We own a lot of assets, so if we're not doing it right, we're going to be in trouble.
So what's the downside for BlackRock and for SMBC of this cultural change?
Yeah, I mean, I think you kind of have to separate the asset optimization for internally owned assets at the organization versus third party services here, which I think is really the focus. And I think it's all about alignment. So the traditional contract structure that we usually see is some sort of availability guarantee on the O&M operator and a fixed fee structure on the asset manager. And we've tried different variations of that. And I'm interested to kind of hear, learn as this gets rolled out, just how do you really align, the performance of the asset for the specific market, particularly if that asset is trying to capture, a lot of different types of revenues. It's not all just energy sales. Maybe there's some ancillary revenues. Maybe there's energy arb, some sort of capacity market that you need to be available for, opportunistic spare parts strategies, things like that. Like, those are all the things that are great to hear that asset manager / O&M provider has those capabilities. But how do you structure and align those incentives in your contract in such a way that they're going to go out and bring those to you for approval and say, here's a way that you can save 5% annually on O&M, and we're going to share in some of that upside. I think that's kind of where the rubber hits the road, is how do you actually structure that and roll that out. But overall, I think it's exciting if you can actually set it up that way, because from an equity owner standpoint, we're closed-ended structure, so we're owning assets for 6 to 12 years, and there will be a core infrastructure owner after us, at least the current fund that we're investing out of, and we need to show alpha, for lack of a better term. Like, we need to show that we outperformed the base case, and here's a great asset for someone to buy down the road.
Mark?
Sure. I think from our side, it's I agreed with everything that's been said by Mike. I think from our side, it's slightly different approach in that we're purely we're lending at a fixed rate for a long term, right? So to the extent the asset overperforms or EBITDA is better, that's good. Of course, we want to see that. We want to see our assets that we lend to perform well, right? But we care a lot more about downside than we care about upside. So here it sounds very good to the extent having better alignment, having better control over these contracts, less blind spots. That's great. I think the devil, of course, is in the details. So I guess we would like to see, obviously, how clearly divided are the responsibilities? Who is EDF subcontracting to? What happens if a subcontractor fails? Details there around the legal structuring. I think it sounds good, and it sounds like it will work. But I think we would need to certainly do more analysis on that side of things.
Okay.
Pricing too. That matters.
Good. I'm glad you had the opportunity to tell him that. So Alex, we have a few minutes left. I think you're the right person to close this out and give us an idea of what the next couple of years for IPPs. We're going to be putting 100 gigawatts of solar in the ground the next couple of years, and just in the United States alone. There's 37 gigawatts of solar right now in the ground. It has to be serviced. It has to be serviced for the next 20 or 30 years. It may have to be repowered. What is the future so bright you have to wear shades? What's your outlook? It's leaving behind that skepticism you talked about earlier. Tell us what you see the relationship between IPPs and financiers, between IPPs and their suppliers, and off-takers. It's a big question.
How much time we have?
2 minutes.
So I think I to steal a phrase from Marlon P. Funk, right? Sun always shining when you cool. But I take
away all the insipid comments now.
That's
with that.
Right.
Okay.
I do very much believe that the future is very bright, right? To use a hip, cool word, I'm very bullish. And I think fundamentally, you're going to see a couple of things that most folks in our business are already seeing. You're going to see entities that are scaling up continue to scale up. You're going to see a lot of the digitization we talked about, enabling those entities to scale up, holding their costs, maybe not flat, but holding them down relative to, the previous 100 megawatts, right? And I think what is particularly exciting for me is two things. One is that the AO side of this business is going to become more and more and more important because it's going to become a bigger and bigger and bigger competitive advantage. And I think the other thing that's really exciting is seeing how maybe not we change is the wrong way to frame it, but how the industry sort of evolved between what we would call utility scale world that I live in for the most part, be it distributed or not, and what Lee is doing in PowerFlex. The true almost atomization of energy and microgrid realities, they're going to start popping up, and then thinking about how those two things that are very different in their physical reality, right, actually interplay in the energy markets. I think that's going to be fascinating. And I think there's a world of opportunity as storage becomes a bigger and bigger and bigger part of all of our lives. You're not going to see solar power plants anyway built in the next couple of years that won't have a storage component. And to the degree we can really start to figure out how to get rid of that icky concept of intermittency, the future will be very bright. Sunglasses all around. All
right. So I think we're going to close it up. I'd like to thank our speakers from PowerFlex, Sumitomo Mitsui, BlackRock, and EDF Renewables, as well as thanking our sponsor, EDF Renewables, and our platform, the good people at SETS. And this is all in preparation for North America Smart Energy Week, which entails SPI as well as ESI. So it's energy storage and solar and smart grid happening in 1 week in New Orleans. So thank you. Laissez-les bon temps brûler, and asset optimization all the way. Ride or die. Absolutely. All right.
Thanks, everyone.
Thank you.
Guys, I enjoyed it. Take care, y'all.
Thank you for joining us for today's digital discussion, What is Asset Optimization? Sponsored by EDF Renewables. Remember to use your discount code below to save on a full conference registration at SPI ESI and Smart Energy Week, this September 20th to the 23rd in New Orleans. And here's what's coming up next from Solar Power Events.